Well, moving on to the fifth and last panel discussion of the day, which is based on solving for the billion-dollar credit gap CEO session, for which I would first like to invite our moderator on stage, please. Mr. Manoj Agrawal, Group Editor, Banking Frontiers. I would now like to invite our panelist on stage, Mr. Vikrant Narang, Deputy CEO, Ambit Finvest. Mr. Deepak Jain, co-founder Flexiloans.com. Ladies and gentlemen, this is our last panel discussion, so let's get a lot of energy. Mr. Sukesh, Bhowal, CEO, Motilal Oswal, Home Finance. Mr. Jugal, Mantri, Executive Director and CEO, Anand, Rathi, Global Finance. Yeah, that's good. Ms. Purvi, Bhavsar, Managing Director, Pahal Financial Services. Mr. Rakesh Kumar, CEO, Light. Mr. Sankar Sastri, Joint CEO, APAC Financial Services. And last but not the least, Mr. Shantanu Rege, Managing Director and CEO, Mahindra Home Finance. Let's welcome all our panelists with a huge, huge round of applause.
Please be seated.
Thank you.
Manoj sir, over to you.
Thank you so much. I really appreciate my team for bringing so many CEOs into this panel discussion, which shows two things. First of all, that NBFC sector is really happening, roaring. Otherwise, it's difficult to get large number of people onto a platform like this. And secondly, though our name is Banking Frontiers and NBFCs is non-banking, I think that those words and names are not some kind of barrier. I think the sector is really working together. Some of you are ex-bankers and happily being NBFCs now. There's no challenge of that sort. So in a CEO session, we are going to typically focus not just on numbers, how we're going to meet billion-dollar, trillion-dollar, whatever. We're going to focus on some of the qualitative aspects of the journey, of the roadmap that is required to achieve this vision of serving the credit needs of the economy, of India's growing, rapidly growing economy. And if I may use a metaphor, we have reached the moon in terms of economic growth, not just technological growth. I look forward to a day when there's a human colony on the moon, which has a lot of Indians in it. And then we can proudly say that moon is a part of India's geography someday.
We'll be financing that.
Yeah, I'll do financing there as well. So let's see who of you sets up your first touch point or outlet or branch on the moon in the days to come. Okay, getting more serious. So we know that there is a global, if I may use the word, uthal-puthal in Hindi. A lot of global changes are happening, unpredictable, whether it's war or global warming or floods or whatever it is. Geopolitics, and that has disrupted a lot of supply chains. And consequentially, there is a lot of new opportunities when it comes to supply chains. And India is trying to grab that opportunity. So my first question to our panelists is, what are the supply chains that you think is something that India should focus upon, where it can really capture, make a difference, capture the market share, and create value for the country? We can start from here, perhaps?
Yeah, sure.
We have mics here. Yes.
Yeah. Yeah. So, before we get there, I think you spoke about NBFCs, non-banks. I think that connotation of a non-bank per se is losing relevance because NBFCs are moving away from the shadow of banking and into the real territory. So I just don't like this connotation anymore of non-banks. Maybe it was prevalent, relevant many years back. but it has changed the
reason
context.
I said this, it was mentioned in the morning. Even I had not in my mind non as an important factor.
That's right.
But that's what the speaker also said, that non is no longer relevant.
Non is no
like you
longer
were saying.
relevant. I think NBFCs now are maybe 25-30% of the total credit which gets disbursed. So it's a pretty relevant sector in that sense. I mean, in terms of, obviously, there are many changes which are happening in the global markets. But I would still say that, I mean, our own domestic economy is still in a very benign phase. I mean, just as I was talking to my fellow panelist also, each one of us is seeing a very strong growth trajectory. And also in a situation where there is not a significant increase, hopefully, from a risk standpoint and from a lending standpoint. So while there is growth, I think people are trying to be better risk managers this time. The greed always follows when there's heavy growth. So the dynamics on the local market remain pretty strong. I hope we continue with the cycle for many years. And in that context, in terms of the supply chains being rewritten, the trade lines being rewritten, obviously that would be a natural consequence. I think in our own, if I just look through our own businesses and our own journeys, we can see that, you know, there are new gateways being formed, whether it is through supply chain means or whether it is with small MSME players, to see how we can onboard them digitally, how they are doing their business on an ongoing basis. We are able to see, you know, their invoicing patterns, their sales patterns, their purchase patterns in a far more digitized way and in a manner that we are able to credit assess them in a far better way. So as there's a further strengthening from a global demand perspective, obviously new industries are coming into fore. We are seeing the government coming up with, say, a mini license Raj, whether it comes to, you know, the IT sector infrastructure, from a tablets, computer, etc. perspective. So there is push on manufacturing, and I think it will all percolate down. And what it does from a lender standpoint, which is where we see businesses as a cohort, we are able to see far more digital flows onto our systems, which are making us far more relevant and far more better risk managers to assess the risk and see how we can do the lending in a better way.
Okay. So kind of diverse supply chains. Okay, let's move on quicker. Any specific examples if you have?
Yeah. So, see, manufacturing in India was one of the most unorganized in terms of there are very many large number of manufacturers across the countries in sectors like fashion, like fashion and apparel, in sectors like steel, infra. What we are seeing is a lot of B2B players are already coming. And in last 4 to 5 years, we've seen a lot of B2B players coming in and solving for standardization in the supply chains. And that's where a lot of financiers like ourselves have also, you know, clocked on to those phenomenon. And as he said, you know, as Vikrant mentioned, that there are very high visibility of invoices or you know, there's a trail of movement of goods, etc., coming in very visibly for all of us to see and finance that. At Flexiloans specifically, we have, you know, disbursed more than 2,500 crores in last 3 years or last 2 years in supply chain financing side. And it's all happening on the back of these invoices being generated digitally. None of this is basis physical invoices. It's all digital footprint. The disbursement on invoices, once the onboarding of the customer happens, you know, first time, the disbursal of invoices happens real time in a fraction of seconds. So those kind of technologies are coming in, and at least I see a lot of standardization happening in there, as well as a lot of brands are coming in. So be it beauty, be it electronics, you know, Boat, Atomberg, Sugar, M-Caffeine, Minimalist, etc., etc. So you're seeing a lot of brands been coming into the country. And on back of that also, you'll see a lot more supply chain standardization happening and supply chain financing happening as well.
Okay. Brands becoming the supply chains of sorts. Okay.
See, I think you have raised a very valid and very important point that when the world is looking outside China and everybody is talking about China +1, so definitely India has got a major role to play. And when we all are like targeting, we all know that the government itself is aspiring that by 2025 we are going to hit $5 trillion economy. So as of now, currently we are around $3.6, $3.7 trillion, and that translates into that, like every day we have to add about $2 billion economy. So when we have to look from the global perspective, that the sectors which are coming to India is be it varying from IT, hardware, networking, from electronics and all that. So a lot of companies have already announced investments in India, and definitely to support them, there'll be ancillary industries which has to come in. And when the ancillary industry comes up, the NBFC, we have always looked at the ancillary industry as a sweet spot. And that is where we see the opportunity that any ancillary industry, be it for the pharma, where the people have started looking India as a manufacturing hub for the generic medicines, definitely there'll be opportunities for a lot of suppliers. Similarly, for electronics and all that, there'll be a lot of vendors. And even like if you see a auto hub comes up, there are more than 5,000 ancillary industry which are there even in Pune itself, when only the Telco and Bajaj and Force Motor is there. So if the number of larger industries comes here, and then we see a lot of ancillary industries which comes around there we see there's humongous opportunity which is going to be available for the NBFCs to cater to those MSME and SME sector.
Okay, all the ancillaries. Great, thank you so much. Okay, anyone?
Okay, so I'll very quickly tell you. From my point of view, I think the kind of geopolitical situation and the climate-related events happening across the world, India and we as a country can play a huge role in food supply chain management, and hence anything to do with agriculture, whether it is food processing, warehousing, all that, strengthens that entire food supply chain management is going to be a good sector. And of course, a lot of challenges in understanding that sector, but that is one thing to look out for. And secondly, if I talk about more domestic and not directly connected to supply chain management, I think missing middle, which is where microfinance companies like us, have a limitation, and the banks are not able to reach. So that is a huge gap that I see as an opportunity as well as challenge to fill in.
Okay, okay. There are other mics also.
Yeah. So fair enough. So I am Rakesh. I head Light based out Ahmedabad and NBFC focusing into microfinance. So panelists have already covered all the points. Would like to, just talk about the limitation of the question. So India, we know, there is a lot of areas, a lot of sectors panelists talked about, like IT, pharma, agri, Purvi talked about. So there are a lot of opportunities, but wherever, NBFC or any other entity, lending entity want to focus, I would again say in the light of rapidly evolving landscape, you talked about disruption. So any sector, any entity want to focus must be having deeper understanding of that sector, must be collaborating with the relevant stakeholders in the industry, like industry association, to understand details about that sector. And last but not least, in the fast changing environment, whatever solution an NBFC intend to provide, it must be customized, else it will not remain relevant, especially when we are talking about global supply chain.
Okay.
Thanks.
Cool. Thank you. Let's move on then. Another point I want to touch upon is cost of customer acquisition. A whole lot of technology interventions and government initiatives to provide digital platforms have made serving the customer or doing the onboarding and collections, GST data, using GST data, etc. All the internal operations have become much more smoother, faster, digital, and hence more economical. But when it comes to the cost of customer acquisition, which is the marketing part, the sales part, the sales force part of it, the feet on street, whoever has any, what do you see as the movement in that area? Is the cost of customer acquisition coming down? Do you really have to apply a lot of technology, or do you have to do partnerships? Or what is it that you're seeing that is effective in making it easier and lower cost to acquire customers? Anyone? Yes, please.
Yeah. See, on the cost of customer acquisition, it's a big topic to consider the kind of lending we do. Primarily, we are a traditional lender in MSME, which is micro enterprises lending up to average ticket size of 5 lakhs, 5.5 lakhs.
Okay.
But we are a traditional lender. We have branches, we have physical branches, we have employees who acquire customers. But that's not something which we have recognized is sustainable as you go forward. Because the kind of competition we have, the kind of attrition you have on the front end basis. So it's very difficult to keep maintaining the momentum. The potential in the segment is huge. That's what keeps driving the growth. The NBFCs are growing. Initially you discussed there is hardly anything non-bank now. Everything is similar. And regulator also recognizes that very clearly. There is hardly any difference between bank and a non-bank now. Everything is similar. But the growth momentum will not sustain. It's sustaining just because of the sheer volume or the number of customers we have. For the segment we are dealing with, we have about 6 crores customer in India.
Okay.
We can easily actually keep thinking next 10 years we can keep growing. Actually, that's the sheer volume. The population of India gives biggest advantage. But then that's not something as internally we are trying to do. We are trying to move away from only depending on the physical infrastructure. We are trying to get this customer segment, which is currently not very, I would say, digital, though they do use WhatsApp or smartphones, say 80% of them do use, but they can be, they can come on board on their own if you train them. That's what we are trying to do, to bring it down. Instead of only depending on front-end people or front-end physical acquisition, as a lender, we are trying to move away from that to reduce and make it more efficient and make it more transparent for customers.
So what would you say your success has been?
Currently, I can't say we are successful. We are very
Still tough.
We are piloting. But what I'm saying is next 5 years, it will change gradually. Unless we start, you can't change it. So we are trying to change that. So currently, we are a traditional lender. We are acquiring in a traditional method, typical lender with a branch with manpower. But we are moving away gradually to acquire it digitally, acquire customer directly, more directly, that customer can understand.
Okay.
Customer can understand, I need a loan, I can reach out to this lender directly, rather than somebody else from our company is reaching out to him as on date. So that's what we are trying to change.
Okay. Anyone else?
So I agree entirely with Shankar. We at Mahindra Home Finance, we have a 7,000 crore balance sheet, but 11,000 employees, right? The more employees, and there's always a lot of advantage to having feet on street, own employees, but it also adds cost. And the ability of the customers to be able to bear that cost, if you have to run a viable, profitable business, especially with all the competition coming in, starts becoming challenging. And therefore, I think the way to go ahead is to form more partnerships, right? There are aggregators in the lending space like DSAs, connectors, even lead gen partners. There is no point in having 10 feet on street when one entity can aggregate that demand and give it to whichever lender is best suited to serve it, right? And therefore, we have a immense focus in ensuring that whatever feet on street we have are productive, and if not, actually enable ourselves technologically to be able to service demand which comes in digitally. And therefore, it will automatically also lead to a segment of customers who have to be served only physically. Increasingly, I feel lenders will say maybe microfinance is best place to serve them, but we would want to focus on, let's say, assisted digital or digital-only customers where they can be served digitally.
Okay.
I'll add a slightly different perspective. So we are a digital-only company. We don't have branches. We don't have feet on street. We don't even operate out of digital aggregators or DSAs. So yet we are disbursing more than 200 crores a month. So how we're doing it? 2 channels. One is B2B2B, where almost all the large ecosystems in the country who are enabling lending, we are the lenders behind it. So be it Amazon, Flipkart, all the sellers on those ecosystems, or PhonePe, etc., that's where we go out and lend to. Second, the digital marketing. And there we get almost 500,000 leads on a website every month. And that's a massive channel of growth for us.
Okay.
So there, coming to your point specifically that what's the, sorry, that's AI for us. So what's happening there is as more and more lenders are coming digital, the costs from Google and Facebook will keep rising. And that's one area for all of us to watch out for, right? Because those are the dominant players there with massive access and reach. So what we are doing is we are addressing a lot of innovative channels. There's a term called Finnovators, which are financial innovators who are basically finfluencers.
Influencers, okay.
Not influencers, but finance influencers.
Right.
So we're using them a lot on local channels and, educating customers that it's okay to come digitally and apply for a loan and you'll get that. Obviously, this backed by what Government of India has done by, ensuring CKYCs and digital agreements and so on and so forth. It's making digital journeys easier and customers sitting anywhere, can apply for a loan.
So this using influencers has been positive?
It's absolutely positive. It's a great source of quality demand. Plus, it's also educating the customers that, okay, you can apply for the loans digitally. Anybody who's new to a segment, for example, a few of us, digital lenders, are creating a segment which is new. Otherwise, for a loan, you had to approach to your CA and get a loan, or you'll approach an agent. It's new in India in last 4 to 5 years. You can apply for a loan digitally. So it's a new segment, and Finfluencers is creating a great job.
That sounds interesting. Yes.
So let me give a slightly different perspective. So let me make 3 or 4 points. Point number 1, if you see from any NBFC's perspective, you got to be profitable. You have to have healthy ROEs. If you don't have that, or if you don't have a trajectory towards that, you're not going to be somebody who's going to attract capital, and you will not. It will not be a successful business in the long term. Mm-hmm. And one of the key ingredients for that is one critical ratio, which is our OPEX to AUM ratio. So I'll give you a broad thumb rule. If your OPEX to AUMs are in, say, high single digits, then obviously you may be in a growth journey, or you're maybe pretty inefficient. I think anywhere between 4 to 5%, if you are operating on an OPEX to AUM ratio, generally you should be reasonably profitable company, unless your credit costs are out of control. And how do you achieve that? I think, so that's kind of one of the main aspect from a cost standpoint. And now if you break this question further, point number 2, I would say there's a horses for courses approach. If you are doing a secured product, you're going deeper into the Indian geography, then you will have to have physical touch. I think technology you can use, technology can automate processes, but it will not do the complete job. So there necessarily you will have to have a phygital model, which means that you automate your processes to the core, but you got to have touch points which reach the last mile of the customer. Now, if you move to, say, the unsecured territory from a loan standpoint, then I think our government has done a fab job. Just in terms of the digital KYC infrastructure, which we have, ability to fetch paperless, personless access, and ensuring the KYC gets done. Now there are multiple avenues through which you can call data with customer consent, whether it is GST, whether it is bank statements, through account aggregator modes, and so on and so forth. Your ability to assess the risk digitally, and ability to even get the customer from a digital perspective, as Deepak mentioned, I think it's possible. So that is a different end of the market. But I do feel where our development is, where we are today, I think we are obviously moving more and more digital. But in certain products, you can automate, but operate with a phygital model. In other situations, you can go deep digital and kind of build a business model on that.
Okay. Sukesh, Purvi.
Yeah, I mean, a lot of interesting points came out. Every product will have a different business model and a cost model. So, I mean, it will vary from anywhere from 5% to 10%, depending on whether it's a microfinance product, or it's an affordable housing loan, or whether it's a prime housing loan. So the cost models will vary. But I think each organization, as a responsible organization, has to be working towards reducing the cost, and the entire ecosystem that the government is building up is helping towards reducing the cost. And I mean, I think as the number of lenders are growing, as the number of customers are growing, that is reducing cost, because the footprint of customers, the number of banked customers is going up. So the ability to understand customers, their repayment behavior is going up, and so your rejections come down. The number of customers that you can lend to is all moving up. And like he mentioned about the UPI has, I think, played a huge role. Even the smaller towns, UPI is getting used, so you can track the transactions. You can, instead of trying to understand cash flows in a physical manner, you're able to understand cash flows through the digital footprint that is building up. So a lot of these things that are the ecosystem that is building, not necessarily related to lending, general ecosystem that is building up is reducing the cost of acquisition.
Right.
And another aspect I would like to, initially someone talked about ultimately you require some people to be there to source customers, and there is a huge amount of attrition because there is huge amount of competition. Everyone wants to get attract people, and that is one of the, I think, a key contributors to the cost, because I think 30-40% people are just coming and moving in and moving out because that adds to the cost, because they're not productive. They remain there for 3 months, 6 months, and then they move out. So I think HR practices itself is a big way in which you can reduce the cost by improving your HR practices, by training people better, by making them stay with the organization for a longer time, which itself is a huge reduction, which could lead to a huge reduction of costs. I think that's something which when we're talking of technology, we try to think of reducing the cost only through the technology interventions, but a lot of costs can get reduced if we manage people much better, manage the frontline productivity much better, and there are various things that needs to be done about that. Yeah, and I think it's a journey. Everyone is working towards that.
It's a big subject that deserves a conference of its own. We'll look that up later. And anything, Purvi, you want to add?
I just wanted to add that, very particular for the microfinance industry, the cost of acquisition, the cost of acquiring a customer is generally very low. But when you talk about the technology, our experience so far has been that in a very short to medium term, the cost is going to go up before it goes down. Because, it is not switching from point A to point B. It is a journey that you have to, take between A to B. So you are not able to get rid of, all the other processes, customer, particularly because we deal with a lot of rural customers. So changing is not all that easy. So, in a short to medium term, the cost is going to go high before it starts giving you the benefit of, using that technology.
But is there some kind of visibility and predictability of that, or it's kind of ambiguous?
No, it is not ambiguous. It is just that you don't know when exactly this journey is going to end. But yeah, it is going to be, to my mind, I think it is about 18 to 24 month cycle where you are able to realize the benefit of the technology that you are trying to implement.
Isn't it possible to take smaller steps and start getting some kind of ROI?
That is exactly what, we do. But one smaller step, that does not mean that, I'll just give you an example. So, for example, in a microfinance, historically, we have only been verifying the KYCs by seeing it ourselves, original verified. That's how it happens, because in rural areas, KYC always is a challenge. If you now move to some technology where, you're using artificial intelligence, you're using aggregator where you can validate Aadhaar card or voter ID, these are the only two documents available in rural areas. The cost of verifying each document is something that, is adding to your cost. Also penny drop, something that where you just want to make sure. Earlier we were doing disbursement in cash, so it was just happening. Now if you want to put that money in the bank account, for every transaction you are spending X amount of money, which was not there earlier. But it gives you more, confidence about the process. You feel more confident, you can scale up much faster because you are in control of that entire process.
Right. Would any of you like to ask each other some question on some aspect of what you see as trying to fulfill India's credit needs in a better way, in a more meaningful way, in overcoming some of the friction?
I'd like to ask Shantanu.
You use the mic, please.
Sorry, yeah. Being from the same field, but much more into the deeper rural territories, and I think the trends have been clearly showing that almost 50% of new originations are happening in the suburban and the rural areas, whether it's a NBFC or whether it's a PSU. With your experience in the rural areas, the income to the cost and the delinquency, does it work out much better? Does that profitability equation work out much better compared to someone who is sitting in Bombay and lending to prime customers and much higher ticket sizes. What's been your experience on that?
Good question.
So, we are one of the few housing finance companies which has lending rates between 9% and 23%, right? So we do prime in Mumbai at, let us say, 9, not Mumbai, but elsewhere. But in deep rural, let us say, Parbhani or Nanded, we will be doing at comparable to microfinance rates. I think if credit is done well, as you go deeper, as you go smaller ticket, there are risks, and the risks are more not necessarily around customers' intent to pay. You can control that, but customers' ability to pay, right? Rural customers are exposed to vagaries of nature, cash flow issues, which probably prime customers, whether SENP, salaried, etc., are just not exposed to, right? And I think at 22%, it is reasonably priced in if you've done your credit well, right?
How do you compare the two in terms of profitability? How do you compare the two? At 9% in Bombay, compared to 23% in Parbhani.
So we've gone through multiple avatars, right? If you're focused purely on ROA or ROE, you should do rural housing very well. It is incredibly profitable. It will be upwards of 5%, kind of ROA business. That is why you're seeing a lot of the affordable housing companies trying to go deeper, trying to do smaller ticket, because that's where all the ROA is. However, over cycles, you will be exposed to volatility in terms of asset quality. Now, whether you have the ability to ride that or not, someone like a Mahindra has the ability to ride that. A smaller housing finance company may not have the ability, right? And that's the trade-off.
So less than 5 lakh category has the highest delinquency, and much, much higher than even between 5 to 10. So you're saying the yields are able to compensate for that. Okay. Thank you.
Anyone? The floor is open. Anyone from the audience would like to ask our panelists some question? We have really esteemed people from the industry here. Okay, maybe they're thinking about it. Meanwhile, let me ask Purvi a question. With your microfinance and reaching out specifically more to women customers, what do you see as this rate at which that is being fulfilled compared to the national, like an average of male, female industry, everything? How is that segment being served, their credit needs, their aspirations? Are their aspirations moving faster than the ability of the industry to serve microfinance to women?
Very good question, very relevant.
Thank you.
I think in last 2-3 years, and particularly post-corona, the speed at which the industry is growing is very, very different. And I'm sure other industries are also growing. But we are seeing a change in aspiration, also not just the women borrowers, but as industry, our ability to reach out to them. Having gone through those difficult times in corona, now we have become a little more braver. We understand risk a little more better. And that is coupled with a very, very strong RBI regulation. I think that regulatory change has played a very critical role in we being able to reach out to more customers. And I'll just give you a small example. Earlier, we were very strictly guided on the rate at which we could lend to the borrowers. And it always became a challenge, because if you want to go more rural, if you wanted to invest more in technology, you couldn't do much because you always had that rate restriction. Now, having removed that restriction, and also having removed a couple of other things like, you cannot be a third lender, and now it is more FOIR based. I think, we are in a much better position to reach out to more people. Also, we are seeing a change in the aspiration and ability of people to pay. So I'm sure earlier people were little focused on savings also, but now people also want to spend. So we are seeing some changes in the pattern in which even this class is behaving.
Okay. Anyone else want to talk about aspirations versus the ability to service those customers, for you to manage the risk gap between the aspirations and the reality?
So
Yes.
I think it is a very interesting time where, NBFC, like non-bank, we were talking about the difference between bank and non-banks are getting blurred, especially because of development in the technology and the way technology is being embraced, especially in rural area. Everyone is seeing how technology is making changes. In NBFC world, there are two segments, I would say: the traditional lenders like us, who do the credit underwriting, collections in a traditional manner. And there are, fintechs and digital lenders who are very, I would say, tech savvy, are very creative and fast, agile in devising the customer journey. So I think I would say that, but then, both the segments have different strengths. So
Okay.
the requirement in days to come, and in order to fulfill the aspirations of the customers in rural and as well as in urban area, is to combine the strengths of both of the worlds. So we need to become agile, we need to become, embrace the technology, should be able to devise the customer journey, should be able to, personalize the service, and technology is available for that. But we have to be very, very careful where to, apply the technology and where, we should be leaving the human angle. But I'm pretty much confident in next 5 to 10 years, even in rural areas, at least with the help of the strength of both of the worlds, there will be democratic access to, I would say, financial services to each and every individual. For example, Purvi talked about, we are microfinance company. We are doing, lending to, I think, lowest ticket size we can say. But even then, because of our operational expenditure, we are not able to do 5,000, 10,000 kind of loan. There is requirement of working capital of 10, 15, 20,000 loan in rural areas. But it's very difficult, almost impossible to do it in a traditional manner. But if we are combining the strengths of, technology, and fintech and digital lenders have been doing, definitely that is possible. Of course, there are challenges, but I'm pretty much sure the way the entire landscape is evolving, it is going to change.
Okay, that's interesting. Friends, we're kind of running behind schedule. So shall we call the discussion, this discussion, to an end so that we can proceed towards the awards function and the other formalities? Yeah? Okay, thank you so much. Thank you very, very much, all of you. Really appreciate you joining us here.
Absolutely. Thank you for such an interesting discussion. I'm sure our audience had many key takeaways from this session. Can I request you to remain on stage for a few more moments? I will now request Mr. Manoj Agrawal to please felicitate our wonderful panelists.
Small token.
Let's have a huge round of applause for all our panelists, please.
Thank you.
Once again, thank you so much for being here with us.